Hi, my name is Darren Joseph from HEJ.tax, and we're the team that seeks to demystify this sometimes confusing world of international tax. And today I want to talk about grantor trust versus non-grantor trust. Well, the first thing you're going to ask is, well, what is a grantor and why is this important? The reason why I want to touch on this today is because there's this, sometimes depending on which practitioners you're using, there may be a phobia when it comes to non-grantor trust, especially foreign non-grantor trust. But from my point of view, it's not necessarily all bad having particularly a foreign non-grantor trust. Let's talk about grantor versus non-grantor and what is a grantor. I'm going to assume that you're already familiar with a foreign trust versus a U.S. domestic trust or a non-foreign trust, because we've covered that in other places and other videos. Basically, a grantor is the person who has created the trust, who the person has contributed assets to the trust. In other jurisdictions, it's known as a settlor, or any person who has made, let's say, gratuitous transfers to the trust. Maybe not the first person, but somebody who's put in a whole lot into the trust, they can be treated as a grantor as well. Generally speaking, from a U.S. tax point of view, you can treat a trust in many ways. Foreign versus non-foreign, simple versus complex. But one of the ways of treating a trust or viewing it from a tax point of view is grantor versus non-grantor. So a grantor trust would be, the grantor is still treated as owning the assets of the trust directly for U.S. income tax purposes. Yes, they've transferred it into a structure, but from a tax point of view, they're still viewed as like the ultimate beneficial owner, right? So the trust can be considered to be disregarded for U.S. income tax purposes, right? If it's a non-grantor trust, well, it's obviously the opposite, right? The trust itself is treated as owning the trust assets for U.S. income tax purposes, not the person who put it in. This kind of comes up because many practitioners will say, hey, that a non-grantor trust, especially because I deal with international, and if you're looking at this, your interest is probably more international than domestic. So from an international point of view, it's a big thing. Make sure that you have a grantor trust versus a non-grantor trust. And the reason often cited is because you get to avoid the throwback rules. There's some rules, basically anti-deferral rules, which I'm just giving you the short version. Income needs to be declared, even though it's not distributed to the beneficiaries, the U.S. beneficiaries every year, it is deemed to have been. And if it's not declared on the income tax return of the beneficiary, even though they didn't receive it, they're deemed to have received it, then there's some really aggressive throwback tax rules that seeks to recapture the previous years in which it was not declared, right? And just to avoid that, those that believe in grantor trust, grantor trust, grantor trust. And I don't necessarily share that view because, as you know, if you've seen any of my other videos, is that I don't believe that one size fits all. There could be some circumstances where you would want a non-grantor trust. For example, because we deal with mixed families, people entering and leaving different jurisdictions, maybe a non-grantor trust would help for those involved in really proactive pre-immigration U.S. tax planning. If you're doing this 5 years out, it can be a great planning opportunity. And again, the rules are very nuanced and you need to get specialist advice, but you can create a foreign non-grantor trust that would isolate some of your income producing assets and keep it separate from you when you do become a U.S. taxpayer. And the tax benefit of that, depending on your situation, can be huge. In addition, like if you're already in the U.S. and you have a foreign relative who's going to be the grantor to the trust and you're mixed family anyway, some of you are U.S. taxpayers, some of you are not, then why would you force that trust to be a grantor trust? Why not keep it as in that case, a foreign non-grantor trust if the settlor or the grantor is overseas and they're not a U.S. person? Because then you're forcing your non-U.S. beneficiary relatives to be subject to the U.S. tax system just because you are. Why punish the non-American members of the family who are beneficiaries because of the American members of the family who are U.S. exposed, right? So why not have it as a non-grantor trust to protect them? And this idea that the throwback rules are such a boogeyman, I don't think they are. Once you have a team that knows what they're doing and that are paying attention, you shouldn't have any throwback rules to be worried about. You just deal with the distributable net income, you deal with the DNI every year, you make sure they're allocated to all the U.S. taxpayers, all the U.S. beneficiaries, and they declare it on their return, and you're good to go. You just keep an eye on it, don't drop the ball, and you're not going to have a problem. At least that's my point of view. One size doesn't fit all. Whoever you're dealing with, whoever's advising you, needs to be conscious and sensitive to your unique needs, your unique family needs. My name is Darren Joseph from HCJ.tax.